Hello friends, how are you all doing? Hope your preparations are going in top speed. Today's session is a part of ACE Accounting Exam series. In this series, we are going to be covering topics and questions which are frequently asked in the exam. So let's start the series with the topic for today being cash flow statement, investing activities decoded. I've split this cash flow topic into three subparts and we will learn each one of them in parts so that we get complete clarity on the concepts. So let's start and decode the investing activities. Here is a balance sheet of X Limited which is given to us. You have the details of the assets and the liabilities here, followed by notes to accounts giving the details of the items which is given the balance sheet, followed by additional information. Now, going through this question, what we are going to concentrate upon today is only the investing activity part, and therefore which area of the balance sheet you should focus upon I will tell you. Now, investing activity means it is going to cover up activities which is related to the long-term assets and long-term investments of the business. So here you have to focus upon the asset side. Under the non-current asset, we have these items of tangible assets, intangible assets, and non-current investments. These are the three items from the balance sheet. You will have to extract the detail and try to find out what is the cash inflow or outflow happening through the changes that has come about in the amounts given in the balance sheet. So let's start. Let us go to those specific note number and see the details. Like for tangible assets, note number 5, intangible assets, note number 6, and there's non-current investment. For non-current investment, there is no notes to accounts. So directly we can compare the amount. 2 lakh was the balance as on 31st March 2017, which has changed to 3 lakh as on 31st March 2018. And therefore, from that we understand there is an increase. Now, what is that increase on account of? Increase represents that further investment was made during that particular year of 1 lakh. So, when investment is made, there is going to be outflow of cash. So, for non-current investment, directly you can take purchase of non-current investment 1 lakh outflow. But we have still left tangible and intangible assets. So let's go to the notes to accounts and have a look at it. Now see, in the tangible assets, note number 5, they have given the detail that the tangible assets is represented by machinery less accumulated depreciation. So they are following the machinery being maintained at cost and all the depreciation related to that machinery is being accumulated separately here. So for the investing activity, to find out the cash inflows and outflows on account of the sale or purchase of machinery, we are supposed to prepare a working note where we will be preparing the machinery account and accumulated depreciation account. And there we would take these balances. The opening balance of machinery on the debit side should be 20 lakh because machinery is an asset, assets have debit balance. And on the credit side, 26 lakh would be the closing balance. And we would also be preparing the accumulated depreciation account. In the accumulated depreciation account, the opening balance should be a credit balance. So it would be by balance brought down and the closing balance would be to balance carried down. So that is where we are going to take these balances. And further, there is one more information about the machinery given in additional information which we have to consider. They have said during the year a piece of machinery costing 8,000. So this is the value included in the cost on which accumulated depreciation was 40,000. So this is the 40,000 included in that accumulated depreciation balance. It was sold at a gain of 10,000. Now here this 10,000 is not the sale value. Be careful while reading. Sometimes a question they said was sold for so much. So that would be the sale value. Here sale value is not given. They have said it was sold at a gain and the gain amount is 10,000. So we have to calculate the sale value here. I hope that is clear. Now let's start. Now before that let us go through this machinery account, opening balance 20 lakh, closing 26. So prepare a format for machinery account. Machinery account opening balance is written on the debit side as to balance brought down 20 lakhs. And the closing balance would be written on the credit side as by balance carried down 26 lakhs. Now for the accumulated depreciation account, look here. The opening balance was 1 lakh, closing was 2 lakh. So let's fill in that. Prepare accumulated depreciation account. Opening balance would be on the credit side. By balance brought down. The amount was 1 lakh. So put it there, 1 lakh. And the closing balance would be written on the debit side. To balance carried down 2 lakh. So from the balance sheet, the information extracted has been fed in here. Next, we are going to consider this information. For this information to be fed in, let us do some calculations here. The cost of machinery which has been sold, they have given as 80,000. And the related accumulated depreciation means so far how much depreciation has been charged for this particular machinery. That is 40,000. So let's accumulate depreciation 40,000. When we subtract this, we are left with 40,000. This is the book value of the machinery which has been sold. Now this is the value to which we have to add gain, or if it was sold at a loss, subtract the loss. So here we add that gain. It was sold at a gain of 10,000. So gain is 10,000. So what was the sale value of that machinery? It is 50,000. The book value was 40,000 and you were able to sell it for 50,000. So you had a gain of 10,000. Now this information let us incorporate in the account. So machinery has been sold. The accumulated depreciation is 40,000. So this 1 lakh includes that 40,000 which has to be removed because that machinery is sold. It's no longer there. So it should not be there in this. So we put it on the opposite side. We will transfer it to machinery account 40,000 and that would come here by accumulated depreciation account. So we put it here 40,000. Once that is done, we have got the sale value. So money has come in. So by bank account, the sale value, we were able to sell it for 50,000 and the gain was 10,000. The gain of 10,000 would have to be credited to profit and loss account. So machinery account debit to statement of profit and loss account. The gain on sale is 10,000. So this is how you incorporate the sale activity here. So now having incorporated that, let us total and see. This is 26 lakh 90,000. 26 lakh 90,000. Subtract this 80,000. 6 lakh 80,000 is the balancing figure which is nothing but to bank account purchases. This 6 lakh 80,000 on the debit side represents the purchases made during the year. And let us close the accumulated depreciation account. How do we close it? Total the debit side, put it on the credit side, find the difference which comes to 1,40,000. This is nothing but the depreciation which is charged during the year. This is not relevant for investing activity part, but when we prepare the operating activity at that point of time, this is a non-cash expense which is to be adjusted. So right now, machinery account is what is important from where we are going to extract the information. So what is going to be taken from here? The amount that is going to be taken from here is the sale value, which is an inflow of 50,000 from sale of the machinery, and the purchase of machine made during the year 6,80,000, which represents outflow. So let's go and incorporate it. So we will prepare the part of the cash flow statement related to investing activity. We will write sale value of machinery or machinery sold, inflow of 50,000, but there was purchases of machinery. We got that balancing figure. Here, this 6,80,000. That has to be written here. It's an outflow, so we will put it in a bracket. Other than that, if you remember, I told you one more thing that has to be considered. That was our non-current investment, which was a direct change, no note. From 2 lakh it increased to 3 lakh, means during the year 1 lakh worth of investment was made. So that represents an outflow. So let's write that. Purchases of investments. An outflow of 1 lakh. Now you might be wondering, I told you this part of intangible asset, 2 lakh and 3 lakh. Note number 6. We have not yet done. Let us go and look. What is the situation? What does it represent? It is represented by goodwill. Now, what has happened? The opening balance was 3 lakh. It has changed to 2 lakh. There is a fall. Whenever in respect of goodwill, if there is a decrease, what does it represent? It represents goodwill amortized. So you have amortized goodwill to the extent of 1 lakh. But if the goodwill value had increased from 3 lakh to maybe 5 lakh, then that 2 lakh increase would have been represented by purchases. That would have led to an outflow in investing activity. But here there has been a decrease, and the decrease is represented by what? Goodwill being amortized during the year. So where does goodwill amortize come? It does not come in investing activity. It comes in operating activity under non-cash expenses. We would add back. We add back depreciation. Similarly, we add back amortization of goodwill. So for the investing activity part, this particular adjustment here, as it is a reduction in goodwill being represented by goodwill amortized, it is not going to come. So these are the only 3 items that we have. So we find that 7,80,000 was the outflow and inflow 50. So 7,80,000 minus 50 would be 7,30,000. It's an outflow. So that is nothing but cash used in investing activity. So during the year, this particular business has used 7,30,000 towards investing activity. So I hope now with this detailed understanding, you have got complete clarity on the investing activity part. Please stay tuned. I will continue the same illustration, but the next video we will be decoding financing activity. So stay tuned and have a great day. Thank you.